with us Mr. Sunil Subramaniam from Sundaram Mutual Fund to talk to us about just that. Sunil, hi, good to be speaking with you. And it's a Saturday, surprisingly so. Are you working today?
Of course, for us, the city never sleeps and Sundaram never sleeps.
But what
So we
about
are,
the NAVs, Sunil, just to get a clarity in terms of mutual fund? Because what I'm hearing from at least my mutual funds is that they're not taking inflows today, they're not taking SIPs, and the NAV adjustments won't happen.
that's true. Because this is a last minute announcement, it's hard to get all the operational things in place, So I think that it is tough to do that. So I don't think the industry is working from a customer perspective because see the issue is for us to suddenly declare a working day for all the employees is also a challenge because this decision happened all of a sudden. So I think while those who have business to do are working, but to get the whole operations act together, I think in just about a day is not a practical feasibility. So that's the reason.
No, absolutely. I take your point. It was a bit of a trouble for us as well to put things together last minute, and would have really appreciated if you would have got the indication a little earlier rather than at 8 p.m. last night. But nonetheless, let's talk about markets. The
Yes.
earnings season so far, Sunil, what do you make of it and the kind of reactions or the exaggerated moves that we are seeing on stock price?
I think it's been tepid so far. And I think it's early days, though. Let's not draw any conclusions. But what has come out so far has not been up to expectations. So we'll wait and watch over the next 2 weeks. I think you'll get more clarity. But the initial numbers reported have not been as great as expected, especially vis-a-vis consensus. See, on an overall number, there could be earnings growth and all of that, but market had expected certain festival season and that related bounce, which I think is not yet visible. We'll wait and watch.
Yeah, wait and watch indeed. But Sunil, if I can just probe you a bit more as far as the banking earnings are concerned, the private banking names, two, three of them have actually reported earnings. What do
Mm.
you make of it? Do you think this is the beginning of the downgrade cycle as such, or is it too early to draw any conclusion on the private banking universe?
I think the downgrades have already happened from a stock price, right?
Mm-hmm.
Banking index hasn't gone anywhere for quite some time now. And I think that's happened because on the back of the RBI announcing those provisions on retail lending plus on NBFC lending. So I think that has had an impact. And also it was common knowledge that the cheap money that they had raised during COVID had been more or less used up and the fresh deposits were coming in at much higher costs. So I think this was out in the public domain. And I think the downgrade that you speak in terms of the P ratios had already started happening. In fact, I believe that the banking numbers should be decent and healthy. I don't expect any negative surprises on the NPA front. And I think NIM margins were expected to compress and it will be in line only. So I would still be an accumulator on the banking stocks on good quality, barring any negative surprise on any particular bank. I would say that given that we are going through this phase where the consumption is not really picked up, right? So to that extent, retail loans, while RBI raised the concern, I think when consumption picks up, you will see a lot more durable financing and all those come in. That's number one. Number two is that I think the capex cycle having got delayed, the loan book growth hasn't been as up to expectations, but it's only a matter of if and not when, right? So it's sorry, it's a matter of when and not if. I use the wrong phrase there. So I believe that while the capex cycle is delayed towards the third quarter of the year and the fourth quarter, we should begin to see private sector capex starting to happen. And when that happens, the banks will be needed to lend there. And at the SME segment, the interest rate pressures are not so much. In fact, in retail, the competitive pressures are very high. That's one of the reasons that NIMs were compressing. But when you get into corporate lending and to SMEs, they are largely at the, if I may use the word, mercy of the banks in terms of their ability to lend there. And I would expect that the loan book growth would exceed expectations. So I think this is a time to accumulate good quality banks, both in the private and the public sector. At this time, I wouldn't pay too much heed to what's happening in the current earnings season on the banks. I think the future is good for them.
Yeah, so what I meant actually, Sunil, when I said downgrade was in terms of the, portfolio allocation in that sense, because everyone is a consensus overweight when it comes to financials still, despite the kind of underperformance that we have seen. And a lot of experts that we were speaking with were pegging as this being the, most outperforming or perhaps in 2024 given the underperformance. But I take your point there. An interesting bit there that you're talking about retail pressure, but the corporate loan book actually growing faster. So the banks which have more exposure to corporate, corporate sector is the one which is expected to show rapid growth. But you were speaking about consumption. And Sunil, last year we saw that big K-shaped recovery when it comes to the luxury segment. Do you think, given this is an election year, there's some sort of populist and mass efforts which are expected to come on that account? Do you think this could be the year when the mid segment and the mass segment also sees a bit of a re-rating apart from luxury?
Absolutely. I agree with you there. I think that the K-shaped recovery has neglected the mass segment, and the mass segment actually consumer sentiment was suffering. And I just saw the data from the RBI that said that finally it has reached pre-COVID levels. That's one. The second thing which gives me support to what you're saying is that rural wages have sharply increased. April to December, if you compare year on year, compared to last year, there's been a sharp increase in rural wages. Also, the Narega demand has come down, which means real employment is happening at higher and higher levels. So I would expect this to translate into mid and mass market segment consumption in the coming months. And you put it right, in an election season, both the government and the opposition parties will tend to spend a lot of money into the economy. And also remember, we are heading into the summer when typically refrigerators and white goods, which are essentially summer driven, will also see a pickup. And finally, from a capital markets perspective, from the stock market, I think that though consumption numbers have not lived up to expectations, I think the capital allocation to them has dropped far more because it's gone to infra preferentially over the last year and a half. So I think the consumption sector has also been deprived of capital. So valuations have suffered. So I think a combination of top line, bottom line, and valuations, all these three makes me think that this is the year of consumption. And I would pick that along with banking as my top two sector picks for the year.
That's a categorical thumbs up to consumption as well as financials. But is it going to be a thumbs up for the public sector entities as well? I mean, it's mind-boggling the kind of moves that we have been seeing. Today, the railway stocks again are up anywhere between 8 to 15%. IRFC is, more, has a higher market capitalization than the likes of M&M Bajaj Auto now. What explains this over-enthusiasm, if I can use that word, Sunil?
I think the fact that the capex is being spent by the government and they expect the PSUs to be also a big vehicle of government capex spending, right? Because their masters are the government, right? And that's one. And they expect that the defense and the railways as infra components, this is where the government can actually spend the money apart from floating tenders for airports and stuff like that. So I think that goodwill from that point of view is what is driving. Second, for years they've been at a discount to the private sector, and probably when there is excess liquidity, which has been the case, right? You have the strong SIP book coming in from domestic. You have FIIs who made a big move back in December, and even last year, except for the first quarter and September and October, they were net buyers through of last year, except for these 5 months, right? First 3 months and the September and October. So I think that this flush of liquidity has forced people to search for what they call apostrophe value, but which is actually low PE stocks. And PSUs are classically related to the private sector counterparts, obviously trading at a discount, whether it's on price to earnings or price to books. So I think that there has been a feeling that they can't fall any further in terms of a relative discount, and there's a lot of money chasing these stocks, and the fact that the liquidity is very less because government ownership in these is still very, very high. So the floating stock is very less. So even a small amount of money chasing has taken these stocks up on a massive rally. Now it's anybody's question in terms of long-term future. I think that this year you will see tactical profit booking occurring in the PSU space as people make their money, because on a long-term spaces, unless there's a strategic divestment, right, the operational efficiencies of the PSU, the desire for the government to always look at them as a source of dividend to finance the government's balance sheet, and all of that remains there, right? So I don't think those concerns go away, but at the same time, where a sector is doing well and a PSU happens to be in the sector, it will naturally get the benefit of the wave of that sector, which is what happened to defense and infra, right? Because that's where the whole story of India was moving around, the infra defense, and those PSUs in that space got it. That all being said, my exception in the PSU piece is the PSU banks, where I believe that corporate lending, they are going to be the leaders. plus this spending by the government, right? Subsidies through direct benefit transfer. It is these PSU banks which have a nationwide reach, and most of that money flow will go through them. So their CASA balances should see strong improvement. So PSU banks are an exception to the whole PSU story, because I think they are in effect going to finance the whole capex cycle and be the vehicle of the government disbursal. So PSU banks, I would still go for good quality banks, not an issue. But other PSUs, it will be sector specific, to some extent stock specific, but bearing in mind that a low PE and a liquidity have been the causes for the rally there. So I would exercise caution in terms of jumping into them unless I get a clear signal that there is going to be a strong EPS growth, independent of all of this.
Sure. Okay, so those are very categorical statements coming in from Sunil. Thanks so much for making time and speaking with us. So the public sector entity